As we enter into the ghost month starting this August 16, how will this superstition affect us whether we believe it or not? Let's discuss. I'm Dan Slim and welcome to another episode of Monday Market Outlook. August and September are seasonally weak months for the market, not only for the Philippine markets but also for the US markets. Now, there are certain factors why this is happening, but mainly this general market weakness also coincides with what is called the ghost month. Now, the ghost month starts from August 16 to September 14. Now, whether you believe in it or not, remember that China is the second largest economy in the world. If the Chinese acts on these superstitions, of course, the whole world could feel the effects of this. As they say, when China sneezes, the whole world can actually catch a cold. Now, last week, China did sneeze with a report on a double-digit plunge in their July export and import numbers, greatly missing expectations. Now, this is pointing towards a falling demand overseas and even in China. Now, if we look at the graph here, exports fell down 14.5%, imports fell down 12.4%. The general weakness in economic demand is also translating into disinflation in China. Now, if we are worrying about inflation in the US, here in the Philippines, we're worrying about high inflation. But in contrast, economies that suffer this inflation is also something to be worried about. If we look at China's CPI, it's below 0%. Even the PPI is at -5. Why is this such a bad thing? Now, if we look at the inflation numbers for China, it is now at -0.03 in a state of disinflation. What happened here is that at the start of the year, we were all hyped about the reopening of the Chinese economy. So companies were producing goods and services to match the anticipated surge in demand. However, what happened here? The surge in demand did not materialize. Companies had excess inventory that they had to push out by cutting prices. While a strong demand can pull prices up, weak demand can also bring prices down. And this is what's happening in China. This weak demand is translating into disinflation numbers for the Chinese economy. And if we look at how this is affecting countries across Asia, we can see that exports are falling all across Asia. Look at Taiwan, falling 23.4%. Korea falling 16.5%. Even in the Philippines, where Moody was projecting our GDP growth rate to be at 5.6%. Look at what happened. GDP numbers came out last week at 4.3%, way below the expectations, which puts our first half growth to only 5.3% versus the target range of 6 to 7%. 4.3% is the lowest since the pandemic and is even lower than pre-pandemic GDP growth levels. If we look at the breakdown of our GDP, we can see the services sector, which comprises 62% of GDP, also going down to 6% growth rate. The services sector contains the banking services, the financial services, insurance, automobile repairs, the Grabs, the Lalamove, the retail sales. So this is the biggest sector for the Philippines. We also have the industrial sector, which comprises 30% of GDP. This would be your construction sector as well as your manufacturing sector. It is down 2.1% from 4%. It's steadily going down. We have your agricultural sector, which comprises 8% of GDP, and it's almost at a standstill at 0.2. The only growth here in the agricultural sector would be mangoes, which grew by 11%, but the fishing sector went down by 13%. The household and final consumption expenditure, which comprises, rents, accommodations, restaurants, travel expenses, is down to 5.5%. And this is what's alarming here. Government expenditure is negative 7.1. Now, we were already complaining that the government was not spending enough to spur the economy, and they even spent less in the second quarter. What's happening here? What is the government doing, considering that tax revenues grew by 11% from last year? Not only that, gross capital formation at negative 0.04. This would represent your construction sector as well as foreign investments. So we are not yet seeing the effects of the president's overseas trips in terms of foreign investments here in the Philippines. The only bright spot here, exports of goods and services are up to 4.1%, but this only represents what, 1 or 2% of GDP. So if we look at our ASEAN neighbors in terms of GDP growth, Indonesia has already overtaken us at 5.2%, and Vietnam is close at our heels with 4.1%. We have Malaysia and Thailand yet to report their GDP numbers, but the projections would be at 3.6 and 3.1%. Now, looking at our peso-dollar exchange rate, the dollar has appreciated, reaching our resistance level here at 56.50, closing at 56.57. If we look at the next resistance, we are looking at 57.50. So look for the peso to weaken further. Thus, of course, as an import-led economy, this again could signal a spike in inflation in the coming months. But overall, if we look at other Asian currencies, we can see the same depreciation happening, which basically means that it's not really our currency that's weakening, but it's actually the dollar strengthening. Now, if we look at rice prices, especially Thailand white rice, which is the benchmark for world rice prices, it is at a 15-year high, while our rice imports are sharply lower in 7 months. Now, if we look at our rice situation, we only have 39 days supply of rice as of August 1. And the requirement is for us to have 60 days of supply. Now, where are we going to get this gap here? We might be forced to import. And if we do import rice at elevated prices, again, this could cause more inflation in the coming months. U.S. oil reserves also at its lowest level since 1985, which has brought oil prices up to 82.8, breaching again a resistance level here at 82. If we look at the CPI basket, we are looking at food comprising 38.8% and rice is 11%. So an increase in rice prices could really affect our CPI numbers. Housing, water, electricity, gas, and other fuels, along with transport also, which is fuel dependent. A rise in oil prices, of course, could cause a spike in our inflation numbers in the coming months. Food and non-alcoholic beverages already comprises 50% of the 4.7% inflation rate last July, with housing, water, electricity, gas, and other fuels comprising 20% of this 4.7 spike. So this is something to watch out for. So as you can see, it is during this time that a lot of negative news tends to come out, which again tends to affect the markets. Now, in other news, MPIC shareholders have already approved the voluntary delisting of MPI in the stock market. So whether we like it or not, this is going to happen. Tender offer at 520 would be the best price that you can get for it. I would recommend taking MPI up on this tender offer. And of course, with this tender offer and with their delisting, the shoe-in to be included in the index would be Bloomberry, which of course, after the news came out of the shareholders' approval of the delisting, Bloomberry shares went up to its resistance level at 12 pesos. So not only that, of course, Bloomberry performing very well beyond expectations for quarter 2. So let's look at the PSEI chart. The China news, of course, caused the market to end below our critical level, and while the market tried to rally the day after, we finally succumbed to the general market weakness, ending the week at 6,400. Now, this puts us on track to our favorite support level here at 6,375, which has saved us numerous times in the past. Now, what happens if we breach that level? We could be headed towards 6,250, which coincides with the 61.8 Fibonacci support level. As we proceed towards the weak months of August and September, we just have to be patient and monitor the markets. Now, if it does breach 6,250, that could actually present a good opportunity to buy good companies at a discount. Now, remember what happened last year here, August 24, right? We went down August, right? And in September, again, a big drawdown in September before we had a big rally starting October, November, and December. So this could happen again this year, who knows? As traders and investors, we just have to be patient and look for the right opportunity for us to enter. But for now, just, keep the powder dry. Make sure you have enough cash position in your portfolio to take advantage of opportunities as they present themselves in the coming months. Onto the global markets, we have more inflation numbers coming in last week, with CPI numbers, core CPI coming in at 4.7%, which is good, below expectations. CPI numbers 3.2, again below expectations, which is good. But if you notice, the CPI numbers was 3% on June, and in July, analysts were predicting 3.3%. So we are already seeing a prediction for inflation to go up. PPI numbers coming in at 0.3% higher than 0.2, which is a leading indicator for inflation. Now, as we see a slight uptick in the CPI numbers, we are looking at some other indicators aside from oil prices, which are also going up. We can see shipping prices steadily going up. Now, looking at JP Morgan's forecast for headline CPI numbers for August and September, we can see a significant expectation of inflation going up during these months. As we look at the seasonality charts, this is how the S&P 500 has performed in the past 10 pre-election years. And if we look at how this year's S&P 500 has performed so far this year, it is tracking nicely with historical data. While again, historical data may not necessarily translate into what will happen in the future for the markets, we can see a high correlation or a high probability that the market may go down in the coming weeks. Now, we are looking at a late August bottom, usually on August 25th, and another bottom by the end of September before, again, we start a rally for Q4. It's also note mentioning that next week would be your third week options expirations week. We haven't been tracking the options market lately because they have grown detached. But at these levels, with 0-day expiration options reaching new highs, this could actually spark a stock market sell-off. And if we look at the options market's favorite stocks, we can see familiar names: Tesla, Nvidia, Apple, Amazon among the options favorite. And if we look at the options chart, we can see the third week options expirations coming in with maximum pain at 438. We could see the market head towards these levels in the coming weeks. And if we look at the S&P 500 chart, we can see that, again, the China data coming in last week also affected the S&P 500s negatively. We are tracking nicely along the expected mean reversion for the S&P 500, and we are currently at around 6,470. Typically, the weak months translate into a 5% drop in the S&P 500. We have currently dropped 3.6%. And if we look at the 5% level, we are looking at 4,380, right? So 4,380, again, coincides with the maximum pain in the options markets. Could we see the S&P 500 move further down in the coming weeks, closer to its maximum pain level? Again, the same scenario here. The weak months for August and September, again, could present a good opportunity. And if we go back to the seasonality charts, the market bottoms here in August and September usually presents good buying opportunities for investors and traders. Again, all of these negative news somehow converges during this time of the year, which leads to weak August and September months. So for now, just be patient, monitor the markets, and spot good opportunities for us to buy back. So that's it for this week. If you found this episode useful, please like this video, subscribe to the channel for more updates, and again, good luck on your trades. Please manage your risk accordingly, and I'll see you again next week. Bye-bye.